AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to episode 128 of the AJ Brown Show, where AJ's mission in life is to make you a better investor. I feel like we called it last week, right? We're continuing our sell-off. What are you seeing? What's driving the market? What are you in the mood to go over first, AJ?
I mean, how can you not touch on consumer price index on Wednesday, right? If we take a look at our economic calendar, we had consumer price index released on Wednesday, and it put the fear of God in investors, it seemed like. Although, if you take a look at the chart, I think it might have been overblown. I mean, the scoop is that the mainstream media needs to fill their minutes on the newscasts, and so they really focused on this. But if we really zoom in on Wednesday's price action right here, yes, there was some selling, definitely some selling from the previous day close. But then during the session, the bears started out the day, but the bulls came back and almost gave us what we call a doji bar. A doji bar is where the open and the close price are just about at the same place. And there's some price action to the top and the bottom. And it basically means an indecisive bar. And so I think by the end of the day, investors were a little bit okay with the consumer price index. It wasn't as extreme as the morning pundits put it. In fact, we haven't yet, maybe today, but we haven't yet got a lower low than what we had seen last week, which was on April 4th. We might get a lower low today. We're currently trading a little lower than April 4th's low, but consumer price index came in hotter than expected. This is where good news is bad news, because let's take a look, Sip, really quick at what investors think about rate drops, right? We've all been thinking, well, first of all, in the beginning of the year, we thought that there'd be at least a point rate drop during 2024. Then it got revised down to 3/4 point rate drop. And, basically just 3 drops during the day, through the year, 1/4 point rate drops. And the first one first they were saying it would start in May. Now they were saying it would start in June. This is May. So pretty much nobody believes that there's going to be any rate drop in May. But now, I don't know if you guys remember what we saw last week, but last week we saw over 50%. In fact, if I take a look at this, last week we saw about 51%. And a month ago, we saw almost 62% chance that we'd have a rate drop. And guess what? Now, nobody thinks that June's going to see a rate drop. I mean, it's 3/4 of the folks think that we're still going to be at the same rate in June. Now, taking a look at July, well, it's 50-50, right? And then there's a small percentage of the people thinking that the floor is going to fall out from under us and that they're going to have to do a 1/2 point rate drop by July. But for the most part, people may not even think that through the summer doldrums we're going to see a rate drop. Now, compared to last week, just 5 trading days ago, everybody thought that we'd at least have a 1/4, if not a 1/2 point rate drop by July. Now, almost everybody's saying that we're either going to have a 1/4 point or no rate drop. And if I jump all the way to December, man, it's back. It looks like this is a really nice bell curve. It looks like everybody is pretty much piling on only a 1/2 point rate cut by the end of the year, rather than 3/4. And that's just been because of this CPI not cooling down, right? The CPI, if we take a look at it, instead of cooling down, it kind of sped up a little bit. Now, one thing I want to point out is the next day, yesterday, we had producers price index. So CPI is a measurement of retail inflation, and it includes a little bit of services as well as, stuff, hard products. The producers price index, this is wholesale inflation. So from the supply chain up, they measure the wholesale inflation, and you can see it's actually on the downward. In fact, it's coming in lower than expected, which means things are cooling off in the supply chain. So the real holdout for inflation is services here in the States. So that's like going to restaurants. Restaurants are still going up in price. Whatever is a service versus stuff. Right now, if you have some cash and you've been looking to buy like washing machines or refrigerators or appliances or beds or whatever products that are hard products, you're going to get some really good sales out there because this is where the slowdown is occurring. Traditionally in economies, it's the services that come slow. And so the CPI, PPI for the Fed, that's just one data point. So I think a lot of hype this week, and I think if you really analyze the S&P, investors figured that out. But I think that there is still an overall hedging going on in the market. And the last data point I can show you, Sip, is if we take a look at things like gold, right? Gold is at an all-time high. Right, $2,445 is roughly where gold's been trading. I mean, that's if we look at the gold chart over, say, the last. We'll wait for this chart to load up on CNBC. If we look over the last, let's look at the last 3 months. I mean, gold has nothing but increased, especially in the last since the beginning of March. So the last month and a half. People are moving their money from stocks and they're putting it into hedges. They're even using crypto. I mean, I saw that Bitcoin's at an all-time high around $70,000. So people are putting their money into crypto. People are putting their money into gold. Oil has been holding steady at around just $87, up to as high as $90, but it's kind of holding steady. And who knows if the influence of what's happening in the Mideast is on oil, but precious metals are up. And so I'm seeing the writing on the wall. And we, like you said, we totally called it. If I take a look at my chart, and I don't know if you want to go to charts, maybe I'll let you. I've been just ranting for like 5.
You made a good point that we tweeted something this morning of where inflation is and where it isn't. And looking at this, over the 12 months, auto insurance is up there, rent, housing, restaurants is up there, like you mentioned. And then, the appliances, the furniture, even airfare is down here, which is surprising. But so knowing this, right? Knowing that the CPI and the PPI don't necessarily take all this into consideration, can we assume that inflation is higher than is being reported, right, in these numbers? And
no, I think that this is a flash in the pan. I think that we got some numbers. I wouldn't be surprised. That these it's the Bureau of Labor Statistics that reports our PPI and our CPI. And so if I take a look at this CPI report again, if I take a look at this CPI report, you'll notice that they've got prior numbers. This isn't one of those reports where they go back and revise the prior numbers, but I wouldn't be surprised, Sip, if these numbers don't come down doubly hard next week. And do remember that this, or don't remember, this is just one data point on inflation. It isn't even the one that the Fed likes the most. The Fed likes the personal consumption expenditures index, which is a kind of a more detailed inflation number. So, this is one data point, and who knows based on how it's calculated. But I think it's more a overall sentiment than just a data point in the air. I think that the market is overbought. I think that a lot of folks have noticed that there's a lot of money in the markets that traditionally wouldn't be in the markets because they got kind of FOMO, that people were making money hand over fist for the last 6 months and they were missing out. So they jumped into the market. And now, I think this is so reminiscent of just 4 or 5 years ago. It's amazing how people have amnesia, but I think seeing some sort of sell-off. I mean, we did diagnose a top on March 28th, and so now seeing where the bottom is really our next thing.
Yeah, I feel like looking at this chart, what is this? A year or year?
This is 6 months.
This is 6 months. That's quite an increase in 6 months, mostly driven by the hope that 2024 we're going to start to lower rates. But it seems as if that news and some of the futures numbers are diminishing that hope. And so for us to even go 50% of the move up, right? I feel like the news and the society would be like, oh, the market's crashing. But no, that would be a healthy, realistic retracement, right? Based off of the data that we're getting, because the run up is, I don't know, pretty significant. And last week we talked about some of the retracements. Are you still seeing those levels holding on the retracements?
Absolutely. So let's talk about kind of from a technical perspective. So you're absolutely right. This kind of run up is unprecedented. You can see that the beginning of our run up has actually gone off of our chart, which basically means that we've been in this kind of bull trend for more than 6 months now. And again, that for an overall medium duration bull trend, shown by our technicals and our retracement, is unprecedented. That's a long run. But we also know that during that 6 months, we haven't had any appreciable pullback. It's those pullbacks where investors can kind of regroup and recharge that keep the trend going. And so when you don't have any appreciable pullbacks, instead of getting a nice parallel support and resistance that people can bank on for years to come, you wind up getting a picture that looks like this. I'll go back to my other drawing. A picture where your support and resistance converge. And when they converge, there comes a point where the weakness just is, you can't ignore it anymore. And we're kind of getting there, and we're starting to see the results of that. And so we finally got yet another sign of weakness on March 28th. And this could be, we won't know yet. It's weird when you're analyzing the broad market, most of your epiphanies come in the rear view mirror. And the Fed is one of the first people to tell us that, right? They're like, we really don't know what's happening until it's already happened. And it usually takes some time. But here's what we need to do. We need to watch where the next bottom reversal is. We got this top reversal on March 28th. And I've got some levels, and I want folks, if you haven't already, I've been talking about these levels now for about 3 weeks, but if you haven't written these down, you should. So the key levels I want you to write down are 5,040, right? 4,905. You could say 4,900 if you want to round it, but 4,905 and 4,555. Should I tell them what those levels mean?
Yes, and from our conversations, they're just like retracement, some Fibonacci component.
Well, and yeah, there's Fibonacci. Fibonacci is quite an interesting topic when it comes to traders. There's some people who fully believe in this whole Fibonacci thing, which is this pattern that they see in nature over and over. Fibonacci's, but that this was a gentleman from well in the past who identified this mathematical formula in nature, and then people love to apply it to everything they see, including traders who apply it to patterns in the markets. And some people really associate it with magic. I actually think, and this is my own personal opinion, but so many people reference the Fibonacci's that I think it's a self-fulfilling prophecy. Like, we're like, oh, that must be the Fibonacci level. And a lot of people trade on that. And that makes those results happen, right? But whether that's the case or not, there is some significance to just like 25%, round numbers, 60%, 40%. So what we're talking about is from the previous reversal. And so, what traders like to look at is if you go all the way past the lowest bottom from the last bottom, that kind of is a bearish signal, right? So that would be this other number I have here, 4,690, right? That's where we bottomed last time, is at 4,690, $4,688.68 to be specific, but roughly 4,690. But we've also determined that if you go about 25% lower than that, that's like an ideal like downtrend, right? And if we also only go about halfway to that 4,600, that's like an ideal pullback to keep the uptrend going. So I gave you those numbers, right? So if we see the next bottom between that 4,905 and 5,040, I'm going to say that, hey, we've kind of pulled back. We've distributed enough that investors could get behind a nice parallel uptrend for the rest of 2024, or at least until, fall, right? So, because I do think that the presidential election that's going to happen here is going to have a minor effect, at least in September, October, and into the beginning of November on our market. So the fall is going to be an interesting time. But for the general, without any external shocks to the market, it could mean an uptrend. So I hope you wrote down those two numbers. Now, if instead we go below 4,905, but stay above the 4,555 number, that means I think for, a good part of 2024, if not well into 2025, we're going to be sideways channeling. And that's where, a bunch of us premium sellers are going to have the upper hand. And folks that are traditionally going long or knowing how to go short, they're going to, directional trades are going to fall flat on people. Whereas us premium sellers, the few, the proud, right? We're going to be able to make money hand over fist. So, and that's actually where I think we're heading. But, I've got my own bias. And finally, if we do dip down below 4,555, I think we have to buckle up as, regular folks, because I think that means that the Fed made a mistake. They were too slow to react at lowering rates, which, the Fed is known for being too slow to react, at least this particular Fed, and they don't lower rates as fast as they should. And it means that we get thrown into a recession and we need to start, looking at how to short the market, which again, options with their put component is perfect. No matter what, being an options trader is a beautiful thing. And so that's where we're at, Sip.
And that's where we're going to continue the conversation. However, I do, when we're talking about, well, I guess if you want to run into the VIX real quick.
I had to throw the VIX up.
But before we do that,
yeah,
are we still shredding cash?
Yeah.
Because I feel like that has been a big reason why we've been at these highs for so long, because we've been creating all this money. And are we still eliminating it?
Yeah, so the Fed is selling back their bonds. The Fed purchased a bunch of bonds during the pandemic. In fact, the Fed started to buy some bonds in 2019. We still don't have any insight into that. I hope that at some point here, a movie is made. Usually a movie is made a decade later when something unusual happens that's unexplained. You can see here what I'm talking about. If I go back a little bit in time, here's the pandemic purchase, all that money being, given. But then there was this weird period. Where are we? We're in, let me just zoom out because I got to see the big picture. Yeah, this weird period right here. I'd like to know what the heck happened, because none of us who are living through that knew why the Fed, after they were doing so well at getting rid of their bonds, letting them mature, started buying bonds. This was before the pandemic, and then this huge spike was the beginning of the pandemic, and then they kept buying, and now you're right. They're on this shredding phase. You can see where they were shredding, and then all of a sudden some of the small banks failed. Let's zoom in a little bit here. You can see that they were shredding. Some small banks failed, so they quickly did some buying, but then they've been on this shredding course. So yeah, what that means is they're selling bonds. And that SIP can actually explain something that has a lot of economists upset. And that is the bond yield inversion. So if I show you these bonds, let's see if I can pull up my little watch list. Short-term bonds are paying higher interest rate than long-term bonds. That's counterintuitive. And in the past, before the Fed was manipulating with bond purchases, this would surely be a sign of a recession. But I can almost say that the reason why the long-term bonds are at a lower rate than the short-term bonds is because the Fed is selling off these long-term bonds. And so they're flooding the market basically to kind of levy up their books. And that's creating this. And so nobody knows, because this is the first time this is happening, but I would almost, because of that explanation, I can almost get behind the fact that this yield inversion may not be a bellwether for a recession the way it has in the past. However, it kind of sucks. It basically says that us individuals who like to invest in government debt, you're not going to get the same amount of bang for your buck if you buy the 10-year yield than you would for the 3-month. And so a lot of us who are investing in bonds are buying the 3-month instead of the 10-year. And that's not good for the long-term U.S. government, right? The U.S. government needs to have this secure line of dollars. But I think it can be explained because the Fed is selling off theirs, and because there's just this flood, they're not paying the same rates. I'm not sure about that. Nobody is sure about that. But it may not be a reason that a recession is coming.
Yeah, bond inversion, bond yields. I mean, I've been in the industry for a while and it still confuses me. So thanks for the explanation. All back to the chart that you had up on the VIX. This was something we talked on last week's show, and shout out to Neil, AJ looking brilliant on the VIX trade. And that was basically because we had the thought that the market could pull back, and if that did happen, the VIX, buying the VIX contract would be a good way to take advantage of that. Is that a fair assumption?
Yeah, absolutely. So let's remind everybody about this whole VIX thing. So the VIX thing is a measurement of how much demand is for options, right? And so typically investors buy options when they're getting a little bit uncertain. We see that people are hedging out of stocks and into gold and even into crypto. But another thing that investors do, especially big money investors, right, is they will buy options as a hedge against their positions. And so when there's this huge demand for options, the price of options goes up. And that's what the VIX is showing us. So when investors get a little bit fearful about what's going to happen next, they start buying options and they raise the price of options. So again, here's another sign that investors are taking actions to kind of protect their portfolios. Now, we talked about over 3 weeks ago about how we wanted to do this VIX trade. And I've got my VIX trade in place, and I almost thought about it. And I was talking to actually the people who are in our program. I was talking about how we could, in theory, sell our VIX trade off early, but I don't want to do that. And the reason why I don't want to do that is because the VIX trade is at its max profit. Anything above $17, if the VIX is trading above $17, it means that when I go to expiration, it means that I'm going to be making the max amount I can. So I'm actually holding on, at least as the VIX today is well above that $17 mark. I'm thinking that I want to let this thing mature a little bit further, because if I give it up early, I'll be leaving money on the table. But yeah, my VIX trade has gone from a small credit of about $0.015 per option share, about $1.50, to almost looking at about $100. So it's almost paying me 100 to 1.
That's crazy. And is expiration the third Friday? So would that be next week?
Next Friday is what we're looking at. I've actually got a bunch of these positions on. The one that I was showing is one that's expiring today. I was using the weekly options, and so I am at max profit, but I've got a bunch of these that I placed on with different expiration dates every week. Next week is the last tranche in my portfolio, but yeah, I'm over the world, especially since I use this trade and I put about 15 to 20% of my portfolio into this trade, especially when the market is doing this. So I'm like on top of the world, but typically the reason why you do this, SIP, is to offset losses in the other 80 to 85% of your portfolio. I haven't seen those yet. All of my other trades are also doing well. So, I'm kind of like over the moon here, and I'm taking defensive measures on the rest of my other portfolio. So I'm getting the gains without actually having the portfolio losses. And so I'm like, I might take the wife out for dinner this weekend.
Hey, let's celebrate. Thank you to the VIX, and thank you to the nervousness of investors driving that up, because we have been teetering at those highs for a while. For anybody watching that sees the little arrows on the chart, that's one of AJ's custom indicators. So if you're interested in getting access to that, I'm going to go ahead and throw the link to that in the chat. It's also in the scroll bar if you want to head on over there and grab a copy of that. I know there's been some cool updates and more variations coming. So if
just yesterday, dude.
Oh, nice.
Just yesterday, if you come over here, so when you go to that link, you'll be able to get free access to our web portal. And I'm showing you our web portal right here. I'm sharing the screen. And so what you'll want to do to get your free indicators is click on the homepage. Your web portal will look a little bit differently than mine, because when you get free access, you don't have all of these buttons like I do. I've got paid access into the web portal, but you will have this one right here in the download center, and it's called the bonus downloads, right? And so you can grab these indicators, and it looks like something like this. And we added that RSI on steroids, the one that everybody's been seeing on my chart, that got added yesterday. Plus you get all these other ones, and you won't get these beta test ones. I'm a beta tester as well for our indicators. You won't see that, but you will see all these other ones. And if you wanted to be a beta tester, just ask the support team if you can be a beta tester, and they'll send you like a questionnaire to make sure that you qualify to be a beta tester. But in the meantime, yeah, these are some pretty fly indicators that we've been using on the show. So you should go grab them.
You should go grab those. And if you're still sitting on the sidelines asking yourself, why didn't I get into that VIX trade? Why am I not using options to take advantage of some of these positions? AJ's got an awesome daily workshop where he's going to teach you 4 of these strategies. So if you haven't checked that out, the link to that is also in the chat. We're going to take a break. That was a solid 30 minutes of, a lot of good stuff, and very exciting to see some of our previous ideas come to fruition at such a rate. I mean, 100 to 1 is pretty wild. But we've got some more names. We've got AJ's pick of the week. We've got AJ's speed round, and then we got a name that we'll run through that we brought up on last week's show. So let us take a break. We'll be right back. Sit tight. If you have any questions, feel free to throw them in the chat. We'll see if we can get through them. Otherwise, we'll be right back shortly.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home. giving you the webinar. I need you to sign up below and meet me in a few minutes.
You know, I'm upset with myself for not taking that VIX trade because we've been talking about that for a while.
Yeah, the VIX trade really, I mean, I'm talking about hundreds of thousands of dollars being added to my portfolio right now, so I'm stoked. There's a lot of liquidity. That's another thing with options trading. Sometimes you're limited, not only by your portfolio size, but by the amount of liquidity. You know, some people forget, Sip, that different than stocks and options, stocks, ETFs, and indexes, there isn't a set amount of shares of options. Options are created by investors like me, right? When I write an option, when I sell to open an option, I'm actually creating the options. So even though you see like these different option chains on the VIX, like I'm showing right here, let me go ahead and get my trades out of the way. You see all these different expiration dates and you see all these different strike prices. The way that it works is the Option Industry Council has created these standardized option contracts, and they basically have a schedule where they make these things available to us investors. But we're the ones who actually decide that we're going to use these legalese documents and start trading them. And so the number of options that are in circulation are created by the number of investors interested in those options, right? And so there's a limited amount depending on how much is traded of these particular options. You can see here, open interest is kind of a measurement, although there are some, in fact, more and more lately, options that are being traded behind the scenes and not being recorded in this open interest number. But you can see here, there's only 2 contracts of this particular option out in circulation. And so if you only have 2 contracts in circulation and you buy one of them, and you want to go and sell them, you may not find a seller. There's just not enough people in there trading those options. So the VIX nicely has a lot of liquidity in other particular strike prices and expiration dates, not mainly the weeklies, but more like the monthlies. You can find a lot of liquidity and be able to trade these things compared to some of the other options. So it makes sense.
Awesome. All right. Before we dig into your pick of the week, let's do a follow-up on a name that we discussed last week, and that was Norwegian Cruise Lines, ticker symbol NCLH. What's the follow-up?
So this was one that we featured last week that I was able to short. And I was, people kind of complained because I had shorted it earlier in the week. And the signal, I was saying it could give us another chance, but for the most part, the signal had passed. Well, it did give us another chance, and we got a lot of feedback around Tuesday this week of people who jumped in to the Norwegian Cruise Line trade. So they either shorted Norwegian Cruise Line, the stock. If they had a margin account, they were shorting it, or they could use a cash account by buying some deep in the money, far out in time. We call them the back month options, right? Either one of those trades is going to profit on the stock going down, right? So whether you short the stock itself or you buy some put options that are like, I'm talking about January 2025 expiration dates, right? We're talking about the January leap in 2025 and deep in the money so that it's a lot of intrinsic value. Basically, it's a stock replacement. It makes money dollar for dollar. As the stock goes down, the put option goes up, right? And so both of those stocks are going to do that. The question is how far does it go, right? If it goes down probably and then starts to come back up around the $14 mark or higher, then what we can do is we can sell put premium against this and turn this into one of our income generating trades where every strike price, every expiration date, we can be getting a little bit of income off of it. However, if it dips below $14, then we'll just look at it as a trending position, a trend follower in the down direction, and we'll just look to get rid of that initial position. Either way, all of us who got into that trade, whether it's paper trading or real money trading, that you're following are in a good position right now. You can see right now we just are trading slightly below the center zone. We're looking for that bottom to be found, and that's when we're going to take the next step.
And it feels like the overall market downtrend is helping fuel this a little bit.
Yes, it's definitely we're on this particular trade. We not only have the wind at our back, but yeah, I think Norwegian Cruise Line as a stock itself has been seeing some negative pressure recently, and so yeah, we're in a good place on this. And I just wanted to feature it because we did get that extra little pop up temporarily. So there was about 2 days there where people could still get in at a good place so that they can make money on this.
And this is just another great example of using options to take advantage of a name that could be pulling to the downside. A stock could be, reversing. A company could be losing money or whatnot. So if you're not using options for that, get into that webinar and start getting active. Otherwise, we've got something else on our radar that we're going to run through. And this is what you're looking at this week. And this is United Airlines, ticker symbol UAL. I feel like the airlines have been getting a lot of drama lately with these malfunctions and videos and doors flying off hinges, things like that.
Dude, you cannot, we are in a time where everybody has like a high res camera in their pocket. You cannot get by with like shenanigans as a company delivering a product or anything because you're going to get captured on video. And then not only that, with a small press of a button, that thing is going to go to everybody else in the world. So all these things that were probably happening, in my childhood and in my adult life that, would just get swept under the carpet because only a few people saw the actual thing that happened. And besides, word of mouth, it wouldn't get spread. Now you've got, a video is worth 1,000 words, right? Oh my goodness. But United Airlines has not been one of those companies yet that has been caught with any of those shenanigans. They've been caught with other shenanigans, but not with like planes falling apart. Like Southwest has had, I think, 2 occurrences in just the last month. But yeah, we've got a nice down arrow, and it looks like we're at resistance. But I'm a little bit gun shy about buying this stock, which is generally what we would do the next time a bottom is found. I'm not saying I'm not going to do that and try to trade the uptrend, but hey, look, earnings is next week, right? And this stock has a little bit of movement in earnings, but traditionally this stock weathers earnings well. However, investors ahead of every one of these earnings have traditionally piled up on options just to be sure, right? They just protect themselves. As we talked about with the VIX, which is a measurement of the number of options being bought on the S&P 500, as far as individual options on United Airlines, when people start buying those options to protect themselves ahead of earnings, we see the price of the options go up. Now, what do we do when prices are up? Well, I mean, I've always learned that you buy low, you sell high. If prices are up, I need to be selling, right? And so that's what we want to do. We want to create a trade, and that's why options are amazing, right? I want to create a trade where I am selling these overpriced options. And the options that are completely overpriced, like extremely overpriced, are the ones that are going to be expiring around this earnings date. So I'm looking at like 10 days. Like I'm looking at maybe April 19th or maybe the weekly option after that, the 26th expiration date, because those are the options that people are using in order to protect themselves ahead of earnings. So those are the ones that are going to be the most expensive. Now, whenever you want to sell options, you have to have something because when you sell an option, you put yourself under an obligation. The person who buys your option has a right to basically enforce or exercise that option at any time. So you have to, because you're under the obligation, you collect a little bit of money from this buyer, right? And you need to be ready to be exercised. So you need to have something that can take care of that obligation, something it's like collateral. And so we want to find some sort of trade that can act as collateral that won't be swayed by this up and down motion. So I'm talking about, just for you academics out there, I've been talking all theoretical here. I'm talking about a calendar spread. See, if we buy an option that's over 6 months to expiration, it's not going to be used as one of these hedging options. Its price is going to remain fairly stable, right? So if I buy that option and then immediately sell the volatile option, right? I'm going to basically buy something at this price, sell something that's overpriced, and then as that earnings goes by and people don't need those anymore and the price comes down, my overall trade is going to go up in price. I know it seems a little complicated, but what I'm talking about here is an earnings play using a calendar spread where the back month option is more than 6 months to expiration. The front month option is going to be like, next week or the following week expiration, because options expire every Friday. And I'm going to create that calendar or horizontal spread, and I'm going to put it on probably on either the 15th or the 16th of April. And then I'm going to look to take it back off right after earnings has happened. So that's my trade of the week. I think that we're going to make a nice chunk in just a couple of days here on this earnings play.
And the trader term for this is called a volatility crush.
Yeah. And so we're going to take advantage by using a calendar spread. We're going to take advantage of the volatility crush that happens. So what I'm saying here is people have raised the price. It's too late to make money on the volatility rush. In other words, make money on the options appreciating in price because the demand, it's already there. The prices are already, I was looking, the prices are already at a high. So now we want to take advantage of the volatility crush. We want to start selling options at this high price and then buy them back when the earnings is in our rear view mirror and people don't want those options anymore. So they're going to sell them back. The price is going to come down, and that's when we're going to buy our options back. I don't know if people remember that movie that I grew up with called Trading Places with Eddie Murphy and Dan Aykroyd, but we're going to basically do what they did in that movie, which was, sell when everybody wanted to buy it and then buy it back when everybody wanted to sell it. So I always talk about being on the right side of the transaction, the correct side of the transaction. That's exactly what we're going to do here. I can't wait till next Friday, Sip. I know that we have a guest on our show next week, but I'm going to take a moment no matter what and explain the exact trade that we did in the beginning of next week to show people how it worked.
And is the assumption that if their earnings come out within expectations and nothing's out of the ordinary, that all that rushing will come back to reality, and that's where the crush makes the most money?
Happens every time.
All right, we'll keep an eye on that. We'll revisit United Airlines next week, like the variation on the strategy. Let's dig into our speed round. We've got a couple names from all across the country, and people want to know AJ's opinion on it. So let's go ahead and start with Tanner in Palo Alto, California, interested in CleanSpark, ticker symbol CLSK. I believe you said something about crypto.
Yeah. I didn't even know what this company was all about. So this is basically they mine cryptocurrencies, CleanSpark. And so Tanner wants us to take a look. Now, this is an interesting play, right? I see a clear line of support here that has basically materialized since about the middle of February. and it's around $15.50. And so I guess my question for you, Tanner, is are you thinking of going long, basically either buying Clean Spark, or we could use the substitute, incorporate a little bit of leverage. You could buy a call option that is, again, far out in time. I'm talking January of 2025. We'll use the leap. And you want to go pretty deep in the money. You want it mainly to be in the money value, not so much extrinsic or time value, premium value. You want this option to have mostly intrinsic value. So to do that, you buy it very deep in the money. And that way it will behave like the stock, but it'll be at a fraction of the price. So I could see you doing that. I don't want you to do that until you get the signal, right? I want you to get a clear signal. You could download our free indicators. These are end of day signals. You can see that we've gotten signals in the past. These are end of day signals that you would then look for the subsequent day to give you follow through. Make sure you plan out price targets, and even when you get follow through, that you're going to hit your price target. If you've already missed your price target, you don't take the trade. But I can see you doing that and getting into this trade long, right, with either buying the stock or buying that substitute call option, letting it appreciate. And then I would put a level probably at around this 23 mark, maybe 24 mark, that if it goes above that, you just look at how you can profit on that initial trade. However, if it starts to come down before then, you start thinking about selling call premium and buying protective puts, creating that income trade. So that's where I would go with Clean Spark. Just realize you want to know a little bit about this company. You want to see if there's some stability, because cryptos traditionally aren't a stable investment that we want to put a lot of bank on. I might, if my calculations when I do the planning tell me to put in a certain amount of shares, I might scale that back. I might make this more of a fun trade than a full-on, like, put all my portfolio into this.
It looks like this company's had a couple pivots. They've been around since 1987, but they're in the mining, which I think is being driven lately by this upcoming Bitcoin halving.
Yeah,
Halving. I keep hearing about that.
having,
So, yeah. So cool. Thank you for that, Tanner. Nice to see some new names in the mix. Moving on to our next name. This is Marjorie from Atlanta, Georgia, interested in another new name, Nano X Imaging, ticker symbol NNOX.
Yeah, I think that these folks are into the medical kind of X-rays and MRI world. Interesting. I'd love to know, and you might know because Marjorie, you probably have researched this. This is a new name to me, so I'd want to do kind of an in-depth analysis on the company. I say in-depth, just reading the news headlines around it, kind of getting an idea of its fundamentals. Something happened here on Valentine's Day, and I'd love to know what that is, because we were trading down here around the $6 mark, and now we're trading up here around the $10 mark. So there's something that happened that increased this stock by over 50% at the moment. But I want to point out this interesting thing that's happening, Marjorie. You might notice that resistance is descending while support is ascending. This is telling me that this symbol, people are unsure of this level, right? They're unsure if this is maintainable. And so they're kind of in this holding phase. This is called a traditional consolidation or a converging channel. Very similar to what we saw in the S&P, where we knew that this was unsustainable. When we see a consolidation like this, basically what we can come to a conclusion on is that this is not going to maintain at this $10.50, $11 level, that it's either going to break out up or break out down. The only thing that we can put our money on is that it's not going to stay sideways. And so there's actually option strategies that work with that, right? There's something called a straddle or a strangle. Maybe a little bit too complex for us to get into with our show ending in a few minutes, but I would research a straddle or a strangle. Straddles and strangles profit on symbols that break out up or down. And they can also be structured, if you want to get really fun with them, to profit on the volatility rush, right? And so if you are able to capitalize on the volatility rush, you could even profit using a straddle and strangle on the potential of a breakout without the breakout even happening. So you may want to look at a straddle or strangle. The other way to trade this would be an active strategy. About 15 years ago, when I was teaching a lot of full-time traders, I would teach them an active strategy where we would actually look at the velocity of price action and use that to automatically trigger either leveraged calls or leveraged puts. So if you want to get kind of into that, you could watch this actively and look at velocity. We used to call it equity. I mean, we still do. We call it equity trader momentum. And you look for an increase in equity trader momentum and you jump in at that time. I would suggest using automatic trading bots to do this. And then you use a trailing stop to get back out, and you have a pre-selected option that is going to act as a stock replacement. And you could, make some quick money on that. A lot of times you have to be categorized as a pattern day trader because these breakouts and breakdowns can happen within a day. And so that's another way to trade this. But what I wouldn't do is I wouldn't try to trade this as a premium trade, right? Because premium trades are in a class of trades called range bound trades. And that means that the stock stays within a range. And this pattern is telling me that it's going to do anything but stay in a range. So don't do premium trading. Instead, look at some of these other strategies. Passive would be the straddle strangle. Active would be this thing where you watch the velocity. You can make money that way. A little bit more. I hope, Marjorie, you're an in-depth trader because those are a little bit more advanced strategies.
All right. NanoX Imaging, ticker symbol NNOX. And moving into our third and final name in our speed round. This is a company that I'm very optimistic on. This is Cal from Houston, Texas, interested in RIVN, ticker symbol RIVN. And I only say that, AJ, because their newest cars look really, really cool.
Oh, I thought you were going to say that because my wife can't stop talking about getting a Rivian. We have a friend who picked one up, and he was supposed to come last Sunday, and then he fell off the map. So I got to find out what happened to my friend. But it was our chance to actually see one because I don't think we have a Rivian. We may, I don't know, but I know that they're way popular where you live. Yeah. Okay. So let's go back a little bit. Let's go back a whole year. Yeah. So there's been an overall negative fallback on just EVs in general. It's almost like there was a gentleman that I used to study about 25 years ago who wrote a book called Crossing the Chasm, which talked about how companies go from selling products to early adopters and innovators, those people who are like diehard new technology people, to the mainstream. And it's a whole, some companies die because they don't know how to cross that chasm. And I think the whole EV market has pretty much, anybody who wanted an EV and was willing to pay for it because they just liked the novelty of it, they've pretty much done that. And so now it's like trying to get the mainstream market folks into EVs. And what a lot of the car companies have found out is that that's, difficult. And a lot of them, like you hear these news headlines about how the big car companies who put in a lot of investment into EVs are scaling back and are going back and taking some of those dollars and putting them back into combustion engines. So I think that the overall sentiment, like with Tesla and Rivian, and we talked about Fisker as well, the overall sentiment is kind of wind in your face instead of wind in your back. So that might explain, because Rivian, I think, is doing okay as a business. But yeah, you can see that their stock price is drawn. Maybe investors are getting a little bit scared. Okay, so I see support at about $10, but I haven't yet seen a bottom found. So I'd like to see a bottom found. But I guess my question for you, Cal, wow, you're in Houston. So I wonder if you're kind of a salmon against the tides in Houston. Houston's a big fossil fuel city. My question is are you thinking Rivian is a good trade for the long term? Like, you want to buy Rivian now because you think it's going to be like an Nvidia or a Tesla, 5 or 10 years, or a Netflix 5 or 10 years from now. And so maybe what you want to be doing is selling cash secured puts, right? So if you're looking to pick up Rivian because you think that this is going to be something that you want to have in your portfolio for the next 5 or 10 years, the traditional way to do that is to put some sort of buy order out there. And you could buy at market prices, which means, hey, I'm going to buy 100 shares and I'll buy it at whatever price it's at. Or some investors or traders say, I'm going to buy at a limit order and I'm going to set the price. Like, say, for instance, I'll buy at $9. Right now it's trading at $9.21. So unless one of the sellers says, I'll sell you at $9, the order doesn't go through, but you're guaranteed to get your price at $9. What I would say to you is there's actually a better way to do it than a limit buy order, right? If you're good with that $9 price, instead of doing $9, a limit buy order, which basically, if the transaction goes through, not only are you out the $9 a share, but you also have to pay some commissions on it. Check this out. Why don't we instead come over here on Rivian? We could go with the April 19th expiration. So that's next Friday. And we look at the $9 put, and it's going for 26.5 cents, right? And if you do it just went to 27 cents. If you do a contract of these, which is 100 shares, it would be $27. You can sell this contract and make $27, right? And what does this contract mean? A put contract basically says that as the seller, you're willing to buy Rivian at $9 if the person who buys your option, the person who gave you $27, is willing to sell it to you at $9. And they have until April 19th to do that. And so check this out. You basically have created a limit buy order at $9, the same thing as before, but you got $27 for doing it, right? And so anytime between now and April 19th, if that person wants to sell you their Rivian for $9, they'll go ahead and do that. You'll get your $9 price, but you got $27 up front. And if they don't decide to sell it to you for $9, you still get to keep the $27. So you get $27 every time for every contract you do of this. Just make sure you have the $9, in this case, $900, because you'll be buying 100 shares in your bank ready to go. But if you were going to do a limit buy order, you have that anyway, right? So I have never bought a stock outright. I've always used this cash secured put buying or put selling method to buy stock, because you buy your stock at the price that you want it to. And if it doesn't go through, you get to keep the money that you got for selling the put option. And if it does go through, you can take that $27, take it off the $900 you bought, and now you're already in the green with owning that stock, because you basically get a discount on the overall trade. So I would do that. I would sell cash secured puts and lock in your purchase price. And you could do it at 9. You could do it at 8.50. It looks like. Let me just make sure I'm not talking. 8.50. You could do it at 8. You could set your price on any one of these strike prices, make a little money, and if it gets through, you buy it at that discounted price. If it doesn't go through, you keep the money that you made by selling the put. You do it next month, or you do it next week. You could do weeklies on these.
And then that would put you into a long position, right? And then
Yeah.
given how many shares you pick up and how long you want to hold, you can just then implement that covered call writing in the future, right?
You
And this is
totally can. If you wanted, you totally can.
so Rivian's one of those interesting companies where their product is really cool. Like their most recent products are really cool. It seems as if they haven't figured out how to make money. The mainstream media hasn't caught on, but that was Tesla for like 5 or 6 years, right? And
Even
then
more, 10
they,
years,
they
right?
blew it out of the water. So Rivian is a very good comp for that. And so
Poised
yeah,
well.
I mean, we'll see. Just this is just from seeing the product and the excitement. Ideally, we'd like to see it be picked up a little bit more all across the country. All right, looks like we got one more name. Mike wants to know about APA. AJ, what are you seeing?
I'm seeing a end of day sell order. It looks like yesterday I got follow through on that sell order if I hadn't gotten follow through the day before. So the April 8th we got an end of day signal. This is on my fast MACD indicator. I don't know. I'd have to look at the intraday chart, but either April 9th or for sure yesterday you got follow through. So the question is do you short this thing? Yeah, you could totally short this. This is Apache, I believe, is part of the whole military industrial complex. I believe, let me verify that. Let's throw in, I'll just put it up here into.
Hydrocarbon exploration.
Oh, okay. Oh, in the oil company. Well, make sure you do your research on this particular stock, but the underlying company, you're right. It's in the fossil fuels, isn't it? In the meantime, yeah, I think you could short this. We've got a dividend coming up. You'll want to make sure if you short it, you put a risk stop in place, some sort of conditional sell. So you could either short the stock or you could buy that substitute put option. Go far out in time. I'm thinking January 2025 again, deep in the money. You want to try to make this thing as high in delta as possible. You want to make sure that the intrinsic value, when I teach my program, I tell people to make sure the intrinsic value is greater than 95% of the option price. So that might be a litmus for you about how deep in the money to go. And now you are leveraged for the short side. Put your stop loss order in place, and then you just wait for the bottom. The whole time you're waiting for the bottom, this thing is going to appreciate. Once you get your bottom, if your bottom is around $30 or maybe even as low as $28, I would sell put premium and buy protective calls. So you'd be selling your put premium when it's at its highest, and you'd be buying your protective calls at its lowest. Probably the call strike price might be 36, 37, 38, something like that. And then you just wait. You wait for your premium options, to expire. Usually you sell your premium options. They're 3 to 5 weeks to expiration. And the next time you get a top, you buy back those call options. Those call options will have appreciated in price, and they will have provided you the protection when you needed it, when the underlying symbol was working against you. And then you just repeat. If instead it bottoms out below $28, don't worry about all that premium selling. Just look for an opportunity to buy to close your short and take your money and run. I like this trade. I'd want to go back and refresh myself about the fundamentals of Apache, make sure everything is going my way. Right now, oil prices are, kind of on the higher side. So you're kind of also, since this is tied to that, you might be having to ask yourself, are oil prices going to go higher in the short term, or are they going to go lower? I don't know the answer to that. You might want to do more research into that as well. So you want to make sure you have your underpinnings straight, but the actual option trade looks solid. Good luck, man.
All right, thanks for that, Mike. Action-packed show today. Lots of movement, lots of opportunities,
Lots of discussions.
lots of great names. I still can't believe that VIX trade worked out so well. That's why we do the show, right? That's why hopefully everybody's tuning in. And if you're wanting more content, more information, more notifications, feel free to hit that like, hit that subscribe, hit that follow button, smash it, let your friends know. We are very happy to bring the show to you every week and provide you with amazing content. If you have any questions along the way, feel free to leave it in the chat, send the team a DM, and someone will get back to you. AJ, to close the week out, heading into the weekend, any final thoughts?
I mean, business as usual. We have options expiration next week. So I'm already looking to sell my May premium. I'm looking at, as we start to see some earnings being scheduled, I'm looking at these volatility plays. I can't wait to follow up on United Airlines next week. Yeah, just business as usual, keeping that money coming in through options trading. That's how we roll.
That's how we roll. And like AJ mentioned, next week we'll have a special guest. We'll have some more information about that throughout the week as we send out our notifications. Otherwise, AJ, thank you for your time. Thank you to everyone that tuned in. We greatly appreciate it. Have a wonderful weekend, and we'll see you guys next week.
Take care, everyone.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.